You're listening to HowStreet.com radio, available online at TalkDigitalNetwork.com. Welcome to HowStreet.com radio, the online source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Welcome to the show, Bob.
Yeah, good morning, Jim. Good to be with you and the listeners.
Well, it looks like China's stock market was about as solid and secure as the plates named China as well.
Well, speaking of plates, there could be a tectonic plate movement going on over there, financially speaking. And their stock market more or less doubled in a year's time, and particularly since early in the year, February, January, in there, it just really soared. So, and as we've been noting, there were some very colorful stories with it, opening up something like 1.5 million accounts a week or something like that, or a month, who cares? And these new accounts were, obviously, you'd have to have an expansion of new brokers to look after the new accounts. And then they were doing new issues, and even there was a story of some remote village in China where a local character had opened an account, and because they were following that the Shanghai index would then be included in Morgan Stanley's global index, and of course that adds premium points on, and so you had local villagers fully aware of Morgan Stanley and what they could do. So that's about as good a story as you can get. And technically, it soared up and gave upside exhaustion signals and everything else, similar to any great blow-off in the past, whether it's 1929 or South Sea Bubble in 1720 or the big stocks in 2000. But we did run it against the Nikkei to their peak right at the end of 1989. And in two steps, this thing is broken down completely. One could say that bubble is over. The pressures from this have yet to radiate around the world, but it will. They could stabilize in here somewhere for a few weeks and maybe make another rally into September, but we now know what's going to happen in the fall on this thing. It's going to fail completely. So, but even on the anecdotal side, there's some similarities with the Tokyo speculation in 1989, late in the year. It was getting pretty wild. And authorities there, now we should back up and say that at that time, the Japanese planning establishment, Miki, M-I-K-I, was considered to be the greatest thing since whenever, because they had a fabulous bubble going. And so nothing could go wrong. And so anyways, they were talking then that they had to curb the boom. And then might have been in February, because the stop of the market was right at year-end. And then the first couple of hard hits to the market, and then there was some policymaker talking about, perhaps we should lower margin requirement in order so it doesn't get too bad, and then it went into that horrendous bear market, and it marked the start of a severe deflationary regime for Japan that certainly tarnished the brilliance of their policymakers, but their policymakers continue to try to do the same thing for all these 20-plus years with no avail, really. But here, with the Shanghai market, there was certainly official talk a month or so ago about this speculation is too severe. We must curb things a little. And then yesterday, we saw it came out that let's lower, after a couple of hard hits, let's lower the margin requirement. So the whole point of this is that a great speculation really is fungible. It has a life of its own, and it doesn't matter whether it's in gold or silver or stocks, in this case stocks. And we know that the similarities with the first one, the South Sea Bubble in 1720, were repeated with, you can use an example in 1929 of the Radio Corp of America, RCA, and then one that I recall in 2000 was Cisco. It looked the exact same, and then you now have the Chinese stock market. It all fits the pattern. So this thing is toast, history gone. One big test, perhaps into September, and then we know what's going to happen in the fall on that. So it won't be a pretty picture, but I think if you want to look at the bright side, there's going to be another set of highly regarded policymakers that are going to look a little embarrassed. So, and it'll likely spread throughout the world.
Yes, we keep talking about the Greek situation, but Greece only accounts for 2% of the European economy. China is a whole bigger piece of the world economy, isn't it?
Oh, yeah, but of course the long ancient tradition is that when lesser countries run into problems, it eventually spreads into the senior countries, and we can quote Cicero, the writer in ancient Roman times, and he did at one point observe that if he had a problem in the eastern provinces, that would mean, as one time was called Asian Minor, the Phoenician market was important then, that it would eventually spread into the financial center in Rome. And indeed, that's what's happened ever since. So the issue with the Greek problem is that although, as you say, at 2% of GDP or something, of European GDP, it's the event, and as it fails, and it certainly will fail, because mainly they're bankrupt, and the problem is not so much that Greece was borrowing reckless amounts of money. It was that the EU was providing them with reckless amounts of money. They could have said no at any time. And then the other thing is insidious, because at one time, say maybe 5 or 6 years ago, the risk was held by banks and near banks and fund managers and stuff like that. So then when you get the government involved, in this case the EU, in bailing things out based upon old shop-worn Keynesian theories, then they've taken the risk out of private sector banks and financial agencies and put it all on the taxpayer. And that's as simple as you can get on it. These theoreticians at the central banks took the risk out of where it should be and parked it unwillingly in the hands of the taxpayer. So your citizen in Greece, he's in a bad position. So no wonder they've been withdrawing money. And then what do you do with the money when you get it out? And anyways, it's just a terrible, ugly situation that will not go away. So here you have again, we'll look to the bright side of a disaster, is that if Greece leaves the EU, then it suggests that other countries could leave the EU, and that would be a good thing, because it's just turned into a monstrous bureaucracy dedicated to practicing Keynesian theories, which were outmoded when he invented them in the early 30s. It'll be on a big picture basis, it'll be very interesting.
We'll have more with Bob Hoye right after this.
More and more people are looking to the internet for intelligent, riveting, and thought-provoking interviews. To advertise on the Goddard Report and TalkDigitalNetwork.com, call 604-699-8600, 604-699-8600.
Welcome back. We're speaking with market historian Bob Hoye. Bob, Canada's finance minister, Joe Oliver, is saying the Greek crisis is nothing to worry about if you're in Canada. He says it won't affect our banks at all. But maybe he's never read Cicero.
Our finance minister, I think, is a pretty sound guy. But in any person in public office like that, they have to say, it's the public man speaking, not him personally. So he has to kind of come out with comforting statements. He can never come out and say the truth. So, this will be a global contraction, and I think, as I said, the best part of it is going to put the efforts to manage an economy or a global economy or anything in a bad light. I think the public's going to realize that all of this intervention stuff has been totally absurd from day one. So, but there's other telltale signs in here. Commodities, recall back at Christmas time, we were looking for a rotation where some beat-up commodities could rally. Out to around May, they did, including gold and silver, including base metals. They did pretty good. And you had a pretty good rally for the petroleum sector with crude oil going up there. And they met targets, momentum targets, generally around May, and then they have since rolled over. And I note the last few days that crude oil has been weak again. So we think there's going to be continued downward pressure on most commodities, although the one group that did not rally with the others, which was the grains, GKX, we called those late bloomers, and they took off a few weeks ago, and then all of a sudden, because what happened is they got depressed when other commodities were going up because there was a discovery of some some moisture, some precipitation in various parts. And then, of course, now you've got an El Nino year, and everything's getting dry and hot again, so the grains have gone straight up, perhaps a little overbought in here. One could sort of, if one were playing it, would take profits. I mean, protect your money. So there will be no help from base metals or any of the commodities. The other one is that in the U.S. dollar index, which reached its best on the year back in March when the pressure was still on commodities, the downside, and then it had quite a good correction. And we're now looking for the U.S. dollar to it's stabilized, and we think it can rally. And one of the things that history has provided is that once you're in a post-bubble contraction, the tendency is that the senior currency, which is still the U.S., becomes chronically strong against most other currencies and most other commodities for most of the time. And the recent stability and building rise in the U.S. dollar looks like it could break out and extend its advance, which would be most discomforting to those who owe money in a weak currency and are trying to pay off money they owe in a hard currency, which is in U.S. dollars into New York. So that's a classic post-bubble condition. And this then, of course, has an effect. Even the dollar going sideways has not been good for gold and silver, and they have stalled out. Gold keeps threatening about that 1130 level, but our advice on gold is, of course, you want to own some of it as an insurance, but you're not looking to make money out of it. If you're looking to make money out of gold in U.S. dollars or whatever currency you're in, that you're just effectively speculating in currency plays. So, and then there's also, within gold and silver, they're kind of like an indicator, the ratio between the two. And in a boom, the gold-silver ratio goes down, and in a contraction, the gold-silver ratio goes up. So the gold-silver ratio is around 75 now, and that, I think if it breaks above 76, that's a new high on the rise, and that would indicate that the financial pressures are getting worse. And you could have a day where, say, gold is down $1 or $2, and silver can be down 1 or 2%, with not the proportionate move in gold. And that really is a telltale that all of a sudden the financial markets are changing. So the way we look at it is that an investor should be looking at gold shares, but not positioned now. We're not bullish and we're not bearish. But at some, obviously for stocks, if we run into liquidity problems in the fall, then even gold stocks will get thrown out with everything else. So, but there'll be a time to invest in these on the improving profit margins in the gold sector, and that, there's no point looking at to invest in these things until they're under some pressure, perhaps in the fall. But we'll be on top of it, that's for sure. So, gosh, we're not telling any particularly good stories today.
Well, what about the advice I heard from someone who said sell and run away right now?
Oh yeah, sell in May and go away. Gosh, it's an old thing, and for this year, in a big speculative market, when the outlying exchanges such as China or Hong Kong get really hot and you're heading towards May, there's a high probability that they would peak. So, and it goes back a long ways. The South Sea bubble, which we mentioned a little while ago, peaked in June of 1720. When I mean peak, this was a huge speculative fury. And insisting it was that the government had done some things to keep that bubble going, and the street knew about it. And then the next bubble was 1772. It peaked in May. Then the next one was 1825. It peaked in May. And then you got out to 1873, where Europe and England peaked in May, but the U.S., then New York was a big enough market by then to be noticed, and it set its high in that September. Then that was repeated in 1929, where London had its high in May or June, and then New York had its high in September. And then you go out to the next classic great bubble, which was 1929, and the New York market peaked in October, so not too far off of past examples. So this is where the action in Hong Kong and Shanghai, for example, and peaking in the May-June window is wonderful. It was a forecast, and it has worked out. And it's amazing how these animated spirits can really get going as you go into April, May, and people were doing absolutely crazy things. So here you have the Shanghai market is definitely broken down. It's broken down so badly that the Chinese authorities are talking about lowering margin requirements, but then that didn't work in Japan back in 1990 either. So the fascinating part is that policymakers will definitely do the same thing each time. The belief now is that policymakers influence events. But if you look at all of these financial manias throughout history, you'll find that policymakers, in effect, are responding to events, especially when you get into the excitement of the conclusion of a speculative mania, and then as it starts to break down. I mean, what choice does a policymaker have other than to utter, as with Canada's finance minister, positive remarks on a deteriorating global scene? So we'll leave that one for people to think about on the weekend.
Well, when you say do politicians lie, don't forget in Greece, 3 days before they shut all the banks and limited the amount of money you could take out to about $60 a day, they promised we will not close the banks and we will not limit the amount of currency you can take out.
Yeah.
And then what did they do?
Yeah. Oh, that goes back to, then after the Second World War and the Bretton Woods Agreement, and we're all currencies were pegged to the U.S. dollar and things like that, but they're all pegged. And then you could tell when one country was getting into trouble, their credit markets would be changing, and they talked to the finance minister, are you going to devalue? No. And then the next day they would. So the point is that in those examples, the moment the finance minister said devaluation, it would happen. So they'd rather happen on an official basis rather than an unofficial basis. But that set up a one-way street for speculators against the peg. I mean, they used to blame the gnomes of Zurich, which would be who knows how many bankers and investors and whatnot or traders, that you can sit there and think on it. Now, you've got a country defending a currency peg. You know it can't go the other way, so it was a natural. But this one, you can get some whipsaws the other way, but it's still going to be the same thing. It will be a contraction in financial markets, but it will also register another massive failure of interventionist economics.
I heard, too, that in Greece, thousands of people are turning to Bitcoin. Is that going to save them at all?
I don't know. I don't follow the Bitcoin thing. I think at some point you may end up with a sound currency, somehow electronic, and the world definitely needs sound money, but I don't have any comments on that. But people will find a way, like when Saddam invaded Kuwait in, 1991, people in anticipation, they knew troubles were coming, and they had went and bought a whole lot of what did they call them those days? Travel checks or something, remember?
Yes, traveler's checks.
Yeah. And they kept the stubs and said you could travel money anywhere that way and to get them redeemed anywhere. So you really didn't even have to have gold or silver at that time. So if you had paper stubs hidden in your luggage, you were fine. So in a distress, the public will find ways to protect itself.
Bob, thank you very much.
Always good to be with you, Jim.
My guest has been market historian Bob Hoye. He's the chief investment strategist for Institutional Advisors. Their website, institutionaladvisors.com. You're listening to HowStreet.com radio. Find us on Twitter at Talk Digital Net. Our YouTube channel is Talk Digital Network. You can forward comments or questions for the show to info@HowStreet.com. I'm Jim Goddard.
Comments made on HowStreet.com radio are an expression of opinion only and should not be construed in any matter whatsoever as recommendations to buy or sell any financial instrument at any time. Available online at TalkDigitalNetwork.com. HowStreet.com radio is a production of HowStreet Media Incorporated.